Let's talk about options trading strategy. In this video, I'm going to share with you an exciting and effective strategy can net your portfolio a 24% return a year if you know how to do it properly. Now, I'll call this an advanced value investing strategy because this strategy is very suitable for long-term investments, but to value investors who do not touch on options much, it may be a little bit advanced. To all the value investors out there, please go through the first 3 videos of our options trading course before executing this strategy. Links to those videos are all in the description below. To the rest of us seasoned option traders out there, this will be the simplest yet effective option trading strategy that you can find. What I'm going to share with you today is termed the wheel strategy. This is just a fancy name that people give it. In fact, it is just selling cash secured puts and covered calls at specific conditions. The aim of the strategy is to generate a 24% return a year for the portfolio, and this can be achieved even when the stocks are moving sideways. The second objective is to be even greedier and ask for a greater discount on the already discounted price of the stocks that you want to own. And in the long run, you may even get to own these valuable stocks for free. Lastly, the reason why this strategy is so good for value investors is because this is an all-win and no-lose strategy. Due to the nature of how value investors work, you will realize that in the long run, we will never lose and stand to gain from all aspects of this strategy. So with that, let's get straight into it. The first step, and also the most important step, is to pick the right stocks to execute this strategy on. So what will be the requirements of the right stock that we should be picking? The answer is simple. We only want to look at fundamentally strong stocks for this strategy. For value investors that have been following our channel so far, thank you for your support. You should already know how to pick fundamentally strong stocks with ease. Otherwise, do not worry, you can say with relatively high confidence that a stock is fundamentally strong as long as it can pass steps 1 to 5 of our value investing strategy, highlighted in the first 4 videos over here. Valuation is not so important at this juncture, as we will have ways to tackle them later. Other than fundamentally strong stocks, you can also apply this strategy to ETFs. After this, the next requirement is to physically have the cash required to purchase 100 shares of the stock that you are applying this strategy on. So after selecting the stocks that you want to execute this strategy on, we next move on to step 2, which is to sell a cash secured put on the stock. Now, why is it called a cash secured put? It is because we have the cash ready to purchase the 100 shares at the strike price in case the put that we sold gets into the money and we get assigned. If you do not have the cash ready to buy the 100 shares, it's known as selling a naked put. And we do not want to do that, as it is the most dangerous thing to do and the easiest way to blow up your account. And you may be confused, since we have the cash ready, why not just purchase the 100 shares for our long-term investment straight away? Why go through so much trouble to sell a cash secured put? Now, the reason is simple. As investors, I'm sure all of us wants to max out our returns and get the best and cheapest price possible for our investments. Even when the stocks that you are looking at is already at fair or undervalued, by selling a cash secured put and collecting the premium, we will be able to use the premium to offset the cost of our investments, essentially lowering our purchase price and allowing us to get an even better price for our investments. For overvalued stocks, you will want to wait for a correction to fair valuation before entering your investment. And we do not want to be waiting for nothing. So meanwhile, what we can do is to sell a cash secured put at the strike price for fair valuation and collect premium while waiting. Now, there are a lot of things to consider when buying and selling options. The first question to ask is, what expiry are we looking at? For this, we want to sell a cash secured put with 30 to 40 days to expiration. If you recall from our option Greeks tutorial, time value decays the fastest during this period. The next critical question is, what strike should we sell at? This depends on the situation. If the stock that you are looking at is undervalued or fair valued, you can choose to sell the put option that is at the money or one strike out of the money. These options should usually have a delta of 0.4 to 0.5. For undervalued stocks, it is a rare opportunity for the stocks to go undervalued. When the stock dips and you sold a put option at this price over here, but you're afraid that the stock price might rise soon after and the put option that you have sold will not be assigned, resulting in you missing out on the opportunity to accumulate cheaply, then you may choose to be more aggressive with selling your put options. In such cases, I will sell a cash secure put that is one strike in the money. And usually these options would have a delta of 0.55 to zero point 0.6. So instead of selling your put options at the money at this location over here, you may choose to sell a higher strike that is, for example, somewhere over here. Now, on the other hand, if the stock is overvalued, then it would be best for you to wait for it to drop into fair value range before entering your position. While waiting, what you could do is to sell a cash secured put at the strike price, which is at fair valuation, and meanwhile collect the premium while waiting. The last criteria, and also the key deciding factor whether or not we will execute this strategy, is that the premium should be at least 2% or more of the underlying strike price. Now, for example, Bank of America is undervalued right now. And how do we know that Bank of America is undervalued? Can you simply go over to FinVis and look at their price to book ratio. Anything from 1 to 1.25, I'll call them fair valuation. And anything less than 1 is to be considered as undervalued. So anything more than 1.25 will then be considered overvalued. So we can clearly see that Bank of America right now is considered undervalued. And the next question as to whether or not Bank of America would be a fundamentally strong company to invest in, you may want to carry out the analysis yourself after going through our value investing course. So Bank of America BAC is now undervalued. It is currently at the price of $24.28. So we go over to the option chain, and first up we look at the option with an expiry that is 30 days away. And this will fall under the 26th June 2020 contract. If you recall, for undervalued stock, we want to sell a put option that is at the money with a delta of 0.4 to 0.5. And from this option chain, you can see that with a current price of $24.28, the strike price of $24 would be considered the option that is at the money. All right, you can see that the delta is at 0.45. Or you could choose to be more aggressive and sell the 24.5 strike or $25 strike. And this respectively would have a delta of 0.5 and 0.56. All right, so let's just say that we want to sell a at the money strike. So $24 strike price, you can see that the bid is offering a $1.22 per contract, and the ask is asking for $1.34 per contract. All right, so let's just stick with the lowest price that's available in the market, and that would be the bid price, $1.22. Now, is the premium being offered by the 24 strike price put option met our last criteria? That is, the premium is more than 2% of the strike price. So you can do a simple calculation and you just take $1.22 divided by 24. And from the calculation, you can see that the premium being offered by the $24 strike price put option is in fact 5%, very much more than the 2% that we are looking out for. Okay, so with that, Bank of America has met all of our criteria, being a fundamentally strong stock that is undervalued and with a expiry of 30 days to expiration, and at the money strike price of 24 put option, and the premium for the $24 strike price, which is at the money, going for $1.22. This meets our last criteria of our premium being 2% of the underlying strike price. We can go ahead and execute the wheel strategy option for Bank of America stock. Okay, so this is for the example of undervalued or fair valued stocks. Now let us look at another example, which is the overvalued stock. And for that, let us look at Apple. Now Apple is currently at $316. Right, if you have conducted the analysis for Apple itself, you should have arrived at an intrinsic value for Apple to be at around $220, around there. All right. And if we allow a maximum buffer of 25% to the IV that we have calculated, it will give us a range of at maximum $270 to $275 around there. This is the maximum fair value threshold that we will accept for Apple to be considered as a fair value stock. So Apple being overvalued right now, the best thing a value investor could do would be to wait for the strike price to come back down to the fair value range at 275 before entering your position. But you do not want to spend months and months waiting for nothing, all right? What if Apple's continue going up and you would have made no money during all these periods of waiting? So while waiting, let us now sell a $275 put option contract for Apple. So likewise, we want to look at the option chain with 30 days to expiration. And again, that will fall under the 26th June 2020 contract. You can see that the 275 put option is not shown over here. So let us expand our strike prices a little bit and let it display 35 strike. Okay, so you can see that the 275 strike put option is going for $1.36 to $1.86. Now, we have to consider the last criteria of our strategy, that is the premium collected should at least be 2% of the strike price. So if we do a simple calculation, 136 divided by 275, and you can see that for Apple, it does not fall into our criteria. If you sell the 275 put option contract, the premium yield from this contract will only be 0.4%. Okay, so in this sense, I would say that Apple would not be a suitable stock right now for us to execute our view strategy on. Okay, so that sums up our example. So before you execute the view strategy to the stock that you have in mind, make sure to go through your analysis thoroughly, make sure that it is a fundamentally strong stock, and make sure that it is undervalued. And also make sure that the option chain that you are looking at has a 30 to 40 days to expiration. Make sure that the strike price that you are selling are appropriate, and for overvalued, make sure that it is at fair valuation. And lastly, most importantly, make sure that the premium you are collecting is at least 2% of your strike price to make all of this worthwhile for you. After executing step 2 and selling our cash secured put, we want to wait patiently for it to expire. At expiry, one of the two things will happen. Either your cash secured put will expire out of the money, in which case you get to collect the full premium, or your put options will fall into the money and you'll get assigned the 100 shares, in which you will have to fork over the money required to purchase the 100 shares of the stock that you're selling the cash secured put on. And it is because of this possibility that you want to always have the cash ready to be assigned the shares. So in my example earlier, you saw that Bank of America is a suitable stock for the execution of this strategy. And let's say if I sold a put option for BAC for $1.20 per contract. Now this essentially brings down my purchase price of Bank of America to $22.80. And if the put option expires on the 26th of June, I'll find a suitable strike again and sell another put, collecting another set of premium and further lowering my purchase price. So can you start to see the power of this strategy now? If you repeat this process long enough, you will continue to lower your purchase price again and again and again. And eventually, the 100 shares of the stock can be eventually bought for free from all the premium that you have collected so far. Now, if I get assigned, it is okay for me too, because Bank of America is already undervalued at the price of $24. And with the premium collected, I now get to purchase my Bank of America 100 shares at $22.80, which is even cheaper for me. And I would have already benefited even more with the discounted purchase cost. So if your puts did not get assigned, you will be looping infinitely within step 2 itself. Once assigned the 100 shares of the stock, we will now move on to step 3 of the strategy. And for step 3, we will now be looking at selling a covered call on the same stock that you have bought. Now, as a long-term investor, we do not sell our shares easily. And the only way for us to profit is through the unrealized capital appreciation when stock price increases. And it can be frustrating if the stock that we own do not goes up or goes up very slowly. As an intelligent investor, we cannot only profit in one direction. And that is why selling covered calls is so powerful to us investors. The aim here is to collect premium and continue to profit at least a little, even when the stock price continues to move sideways or continues to drop. Now, it is termed a covered call because we have the underlying shares to protect us from the downside of selling a call. If you do not own the 100 shares, it will be the equivalent of selling a naked call. And once again, we never want to sell naked when it comes to option, as it is the best way for self-destruction. Now, most of the criteria of selecting our sold call is the same as selecting the put. We always want to make sure that the premium to be at least 2% of the strike price. And we ideally want the expiry to be within 30 days to 40 days of expiration. And this is to capture the fastest time decay and profit as quickly as possible. The only slight different criteria in this case is the strike price. Now we still want to sell the call option with a strike that is at the money or one strike out of the money. And these options likewise will still have a delta of 0.4 to 0.5. Now when selling a covered call, it isn't a problem if the strike price that we have chosen is above or equal to our purchase price. In these two cases, you will learn that we will always profit. Now the trouble comes when the strike price that we sell is lower than the purchase price of our stock. In this case, if you still choose to sell a call option that is at the money, you will risk getting your shares caught away at a lower price than your purchase price. And this will result in the risk of making a loss for you. Now to circumvent this, we can choose to sell a further out of the money strike that is at our purchase price. But in this case, we will most likely not be able to meet the criteria of our premium being at least 2% of our strike price. Now to satisfy these criteria, which is very important, we can choose to look at a further out expiry, maybe 60 to 90 days to expiry instead. Now out of the entire strategy, this is the only situation that will cause us problems. And we will be dedicating a separate video to discuss specifically the implications of it and my way of dealing with it personally. So likewise, after selling a covered call, we wait patiently for one of the two possible outcomes to happen. The first is that the covered call falls out of the money and expires worthless. And if that happens, we get to keep all the premium that we've collected. Then we just go out again to sell another covered call following the same criteria as discussed in step 3. The second possible outcome is that the sold call falls into the money. Now in this case, our 100 shares will get caught away. If you let this happen, then go back to step 2 and rinse and repeat the procedure again. But as a long-term investor, we've waited so long to get our discounted shares. Of course, we will not let them go so easily, right? What if we let them go and then the stock price skyrockets afterwards? Therefore, normally I will not let this happen. I will manage my costs such that I will always get to keep my shares. And how can we do that? What you can do is, when your sold covered call reaches a delta of 0.8, you can choose to roll your covered call to a new one with a different or the same expiry and at a higher strike price. The decision to select the respective covered call will be guided by the same criteria as discussed in step 3. For those who do not understand, rolling an option contract simply means to close out a previous position. In this case, we will be buying to cover our sold call. And at the same time, we will be opening a new position. In other words, we will be selling another covered call with these conditions. And for those of you who are wondering, wouldn't we be covering our sold covered calls at a loss then? Well, the answer is no, because we have our underlying shares to protect us. Recall the definition of delta. With a delta of 0.8, what it means is that for every $1 increase in the stock price, our option value increases by 80 cents. But since we sold a call, this means that for every $1 increase in stock price, we will lose only 80 cents. And we still have a net profit of 20 cents for every $1 increase in the stock price. And that translates to a 20% gain. Now, if you execute this strategy on all the stocks that you have in your portfolio, you'll be collecting at least 2% worth of premium every 30 to 40 days. And this essentially means every month. And in a year with 12 months, that will accumulate to 24% return on your portfolio per year. And this is for when your stock prices trade sideways or drops. If your stock prices are going up, your returns will be much more than this. This sums up the wonderful and powerful wheel strategy for us long-term investors to boost the returns of our boring long-term portfolio. In short, you want to pick the correct stock to execute this strategy on, preferably one that is fundamentally strong, and then repeatedly sell cash secured puts on it till you get assigned the shares one day. And from then on, continue to sell covered calls and manage your covered calls properly. And when performed properly, every time your cash secured put or covered call expires, the premium collected will be able to boost your profit tremendously in the perspective of a long-term investor. Now in the next video, we will be focusing on the areas in this strategy that will require more attention, as well as troubleshooting during exceptional situations and some tips and tricks to optimize execution of this strategy perfectly. As always, do show your support by dropping a like and subscribe to the channel. Thank you so much for watching and see you next time.